All right, waiting for people to join. All right, guys, we're just waiting for more people to join. I see everyone is kind of joining the room. We have quite a few already here, so we'll just give another minute. Panelist, all right. Hello, Saad. All right, we're just waiting for another minute while people are joining. We already have quite a few here. A lot of familiar names and and faces, of course, because we know those people, and that's still a lot of new people. So while we're waiting, before I pass it over to you, I will do a quick introduction for those who are new. In the meantime, before we do that, do you want to quickly test that your sharing works?
Just a
In case you need to
second.
request.
Yeah, it says host disabled.
Is there option for you to request?
No.
No. All right. Let me just do it from my end then. List. All right. Amira, you should be able to request it from your side. We're still waiting for people to join, guys. So just make yourself comfortable. We're getting ready for some very interesting content from Saad. All right, Saad, try now if it works. Should work
Yeah.
now. Yeah. All right. Yeah. All right, perfect. Okay, while you're testing your sharing options, share screen options, just a quick kind of welcome to everyone, and good to have you all here with us. It's my pleasure always to have those webinars. We try to do them, regularly every month and a half. I think it's been a bit longer this time. We've been very busy with restructuring certain things, pivoting. As you all aware, you all in the renewable energy space, so you are well aware that it's all kind of very dynamic, a lot of geopolitical changes, a lot of things that require us to accommodate as well. So this is what we've been busy with. And just for those who are first time having interaction with us, we are deal advisory and a co-development firm. So focusing not preliminary, but pretty much exclusively on renewable energy and sustainability. So we work with solar, wind, hydropower, geothermal, waste to energy, energy storage, hydrogen production, and data center projects. Of course, our primary focus lately been on standalone BESS and PV plus BESS and also data centers, primarily in Europe, but also a bit in North America, Canada, US, and Australia. Occasionally, we also work with some emerging markets as long as the country is politically, economically stable. We can look at projects there, but our efforts at the moment are focused on rolling out our new co-development model along with our deal advisory, and focusing, of course, mostly on Europe because with the current changes, Europe is in the situation where it really needs to think of its. I don't want to go into politics, but it's obvious for everyone that it's time for Europe to take seriously their energy security, energy independence. Today's session is related actually to this topic. It's actually, as you guys know, it's risk bankability and mitigation for renewable energy projects. And Saad will be leading this session. He's currently, as we are very glad to have Saad as a part of our due diligence deal advisory team, and Saad comes with a great experience and expertise across a few sectors, but mainly in the green energy, renewable energy space. So for his former senior advisor at KPMG Middle East with more than 15 years in the renewable energy and infrastructure, not only in MENA, but also across Europe and South Asia. So Format for today's webinar is that Saad will walk through the framework first, and then we will have open Q&A. So for the Q&A, for those who are not familiar with Zoom, there is a separate. We don't post questions in chat. There is a separate button, and it's called Q&A. If you don't see it at the bottom in your navigation panel, there should be a little button called More, and then if you click on it, then there is a Q&A. So you post your questions through the webinar, and then in the end we'll have Q&A session, and we will address all of those questions, as many, of course, as possible. For those who have missed registered but missed the webinar, we will be sharing the recording. I will make a few more announcements during the session. But for now, Saad, over to you, please. And thank you again for making yourself available and sharing your experience, your wisdom with us and with our audience. I will be on the
Anytime.
background. I will be managing, questions and chat. If you need me, just I'll switch off my camera, not to clutter the screen, so everyone can go and see everything on the full screen in terms of your presentation. All right?
Thanks, Vlad. Thanks. And I think thanks for organizing this session on such an important topic, which is risk, bankability, and mitigation. We are seeing that market is evolving with this technology in the renewable energy space, and the investments is accelerating, right? So during this, we are going to cover the framework of the risk, the taxonomy of the risk, and how do we address these risks to make the projects more bankable in nature, right? So we all understand that risk is something which is very important in terms of mitigating, right? So that we can make the project bankable. Now, I understand this is one of the best times to have this discussion because we are working with the developers, and on daily basis, we see that there is a perception of developers that their project is ready to build, right? And when we start speaking with the developers, then we realize that there's a gap. That there's a gap in the understanding of perception that project is ready to build, and while the project is bankable in nature for the lenders as well as for the investors. Now we see that the market is quite active, and we have seen in past that around $2.2 trillion of investment has been made in clean energy itself. And that is roughly double the size of what investment has been made into oil and gas. So market is quite active, it is accelerating. The projects are being planned in such a way that the developers are ready to deploy those projects. And we are working along with them, right? Now, we see that the market is still very promising. In next 5 years, 2025 to 2030, we see there will be an additional 4,600 gigawatt of energy to be added in this space. And this is just amazing, right? That with the kind of surge in the demand driven by the AI processing, driven by the transport electrification, there's a huge surge in the demand. And that is why the technology keeps on evolving. The key gap which we see right now is when the projects which are being financed and the projects which are not able to be financed. And that gap is basically widening. And to understand what that gap is, we have organized this session so that we all come on the same page to understand what this bankability actually is, right? So right now, it's very good to see that the market looks very promising. Market is attracting a lot of projects. The developers are planning a lot of projects. Most of the governments are coming up with different incentive programs for renewable projects to be mandated. But at the same time, we realize that's only half the picture, right? We also understand that's half the picture because the other face of the coin is bankability. And we are seeing that the bankability is becoming harder and harder as we progress. And why is that so? Because there are certain factors which we have understood by speaking with the developers, by speaking with the lenders, by speaking with the investors, that these are the key factors which are putting pressure on the bankability. Let's understand what these are, right? We have seen in past 5 and 10 years, there is a pressure on the PPA prices by market. We have seen that the PPA prices of the solar project as well as onshore wind project are on decline. The decline to the fact that the solar prices have reached to 0.043 kilowatt per hour, and the onshore wind prices have reached to 0.034 kilowatt per hour, right? And this is making the economics of the project very difficult to make it bankable. So the economics is tightening, right? So that is one of the reasons that compressing PPA prices across the market is tightening the economics of the project. At the same time, we also understand that the merchant exposure is rising, right? Off-takers are not willing to take up the long tenor projects, and that is why there is the risk on towards the pricing of the project as well, to understand that what will be the price once the project is exposed to merchant exposure. Uh, Third factor is grid. Now, this is something which everyone must in this space must have heard of, right? That there are long queues within the grid, especially if you look at the Europe area, if you look at the continents of Australia, there is a stretching in terms of queue for next 5 years. I'll give you the example of Alberta in Canada itself. Last year, 29 data centers requested for the approval to get connected to the grid with the capacity of 16 gigawatt hour. That was the capacity, that was the requirement to be added. But the available capacity is only 1,250 megawatts. That's only 7.5% of the requested demand which has been coming into the market. So that is the kind of queue which we see in the market right now in terms of getting connected to the grid. In the same way, we are seeing that the policies are changing in the country. We have seen the price volatility in last 3-4 years due to the emerging situation in the world. So the EPC margins are also under stress, and we see a lot of developers are exiting the market or they are being restructured. In the same way, technology, which is key right now. So technology is evolving after every 12 to 18 months. It is becoming for the insurance market to see how we can basically insure these products, which is evolving. It is becoming also very difficult for the bankability assessment for the technology. So these are some of the factors which are affecting the bankability right now. But let's try to understand what this bankability is all about, right? Because we see a lot of people, a lot of developers, a lot of public sectors, they are talking about bankability. So let's first understand what this bankability is, right? So a project will be defined as bankable is if the risk return profile is acceptable to non-course lenders and equity investors, right? Which allows a project on the terms which allows the project to be financed. Now, let's see bankability from the lens of two different stakeholders. We are talking about the lenders and we are talking about the equity investors, right? Now, lenders are always looking at the project and assessing whether this project would be able to generate enough cash flows so that my debt can be serviced, right? Even in the downside scenario. That is the lens but through which lender is basically viewing this bankability term. At the same time, equity investors, he wants to understand that once the debt is repaid, it is serviced, whether the cash distribution to the equity holders, will it be able to deliver the target IRR, right? So both the lens are two different lenses. They are different, but at the same time, that's the beauty of the structuring the transaction, that you need to understand what are the different forces which would bring the lenders as well as the equity investors on the same page so that they can sign in the project. Let us try to understand which are these forces which needs to be balanced. So here we are talking about risk, we are talking about return, and we are talking about financeability. So every bankable project balances three forces. You need to identify what those risks are, right? And how do you reduce those risks? Now, reducing risk comes with a cost. You are going to sign a tolling agreement. You are going to sign a fixed price PPA. You are going to have delay startup insurances. All, all of the mitigants, all of these tools have a cost associated to it, right? And to make the cash flow certain, someone has to bear that cost. And if you increase that particular cost in terms of understanding, in terms of mitigating the risk, then your returns are compressed. So that is one of the forces which you basically need to identify, which you need to look at how do I reduce that. Now, let's talk about the returns, right? We see that the merchant pricing and the off-takers are quite open to merchant pricing, right? Which is volatile. And it is volatile, but at the same time, it provides the upside to the equity investors. But when you go into an agreement, when you sign an agreement on merchant basis, then you have to face higher hurdle rates. You have to face the debt terms, which are quite tighter in nature as compared to the projects when you have the PPAs with it, right? So these two forces are very important, which needs to be balanced. And finally, financeability, right? Now, the main constraint is not the risk, it's not the return. It's going to be the financeability. If you are not able to if you are not able to finance the project, if you're not getting the projects over the line, then your risk and return doesn't matter a lot because you're not getting the project built, right? So every time when we start evaluating the project, we need to understand that the structure which we are trying to develop, which of the three corners I'm trying to move. And if I'm moving one of those corners, what is the cost at which I'm moving this corner, which is going to impact my other two forces, right? So once you then sit together, you discuss with the developers, you discuss with the experts, and try to understand how do I reduce this risk, right? Now, when it comes to reducing the risk, first you need to understand how do I identify the risk. It's very important to see how you can identify the risk at a time when the project is made available in the market. So let's understand how do we identify the risks once the project is planned. And this is basically, again, through the five lens risk identification approach, right? And when I say it is a five lens risk identification approach, because you will not find this approach anywhere in the textbook. This is based on the experience which we have gained working on multiple projects across the different transactions, whether it is renewable energy, whether it is any other utility project. You have to go through that particular cycle to understand which risks are these, right? So let's basically go through these five different lenses to see how do we basically approach them to identify the risk. Document review. Now, once you start with the project, you need to understand that you have certain documents with you. You have EPC document, you have O&M document, right? You have other feasibility studies. You are trying to understand that on what are those agreements which has been agreed, what are the terms which has been agreed to finalize those agreements, right? Have we missed out anything, or we have captured all the aspects of the project so that it can be bankable, right? So we assume we'll go through the terms of these agreements and we list it down. Once we have these risks from the documentation review, we move to the expert interviews. We have legal advisors, we have technical advisors, we have the insurance market specialists, and especially those who are already in the grid business, who are the system operators. You speak to them to understand, have we missed anything from these existing documents which we have reviewed, right? So because they will provide you the insights that what are the key risks which are still there, which were not so obvious in the documents and which you should capture. So you speak to them, try to understand what are they going to project, and record those risks from through the expert interviews. Let's look at the site assessment. You work very closely with the developers. You try to understand in reality, because site is in reality. Location is physical in nature, which already exists, where you are going to develop the project, right? So you need to understand whether the site is going to support the development of the project or not, whether the topography of the land or the site is supporting the project or not, whether we have done geotechnical studies, whether this site is going to receive the resource in terms of solar irradiance or the wind speed, so that we can estimate that what kind of energy would be generated based on this site, right? So we speak to them, we try to understand, speak to developers, try to have a number of reports to assess that what is missing, what are the weak links which we should capture in our risk register. Moving to market intelligence. Now, external forces play a very important role, right? So if you have any kind of supply chain disruption, if you have any event in the world which directly impacts your cost, it if you are basically raising the financing, if you have the investors across the globe, then any changes in the interest rate is going to impact the economics of your project. So this understanding of external forces of the market is key in terms of defining the assumptions for your project. That are we so optimistic to see in terms of defining the assumptions, or we are the assumptions which we are defining across our base case are quite robust so that we can run our project in a successful way, right? And finally, I think historical data is very key. Historical data is very key because what you are trying to compare, you are trying to say that this is a project which I'm going to develop in the market. Let's compare my assumptions with the project which has already been executed in the market, which is similar in nature. So we are comparing like to like projects to see that the assumptions which we are considering right now, irrespective, we are talking about, suppose in particular in geography, we have done solar PV project, we are comparing the projects over there to understand that our assumptions and the project which already producing the performance of the project, how do we compare them, right? So once we go across the entire cycle of identification of the risks, it covers all the angles. So the beauty of this five lens risk approach is that you are not evaluating the risk only from one angle. You are covering all different aspects of the project. You are trying to cover all the different angles and try to capture all the risks in your risk register once it has been prepared. Now, once we have identified the risk, let's try to understand that how do you categorize those risks, right? How do you name those risks? What is the taxonomy of those risks? Now, so here, based on our experience, and of course, based, as we said, right, from the identification process, we have tried to club the risks under 9 different categories, which I would believe every renewable energy project should navigate to, right? And there would be other minor risks as well, which can be classified under these risks. So I'll go very quickly through these risks because we have the slide dedicated for each risk in our subsequent slides. But this is very important to understand to see what these risks are, right? So let's begin. Now resource is very important because it tells you whether the energy which you are generating is lower as you expected because of any kind of forecast. Suppose we had yield assessment on the basis of P50, P90, right? We are assuming that this is the generation. So we need to understand whether the energy which has been generated will be lower than the expectations so that we can capture then risk. We go out in the market, we do these studies, yield assessment studies to capture P50, P90 yield assessment. Technology is evolving, right? And this is something which can fail the project because your equipments may degrade much quicker as you compared, right? And your equipments may fail in the market. Your technology is evolving for the wind, for the solar, and for the battery energy storage system. So you need to capture all those risks, and you need to understand what are the different tools which we would deploy so that we can mitigate the risk. Now, construction. Now, this is not no-brainer, right? Everyone who is in the infrastructure business knows about the construction risks. Now, the project can be delayed. The project can have cost overruns. The project might not be performing the way it was expected to perform. There will be performance shortfalls. There will be issues in the completion of the construction of the project, right? So we need to capture all the aspects of the construction, what it could basically be, what can contribute to the failure of the construction, and we'll capture, and then we need to understand what are the different mitigating tools which would be deployed for the construction. Most important now, revenue and market. As we see and we discussed previously that the PPA prices are declining, right? There's more exposure to the merchant tail, we are also seeing that the new projects are entering into the market and there will be a cannibalization. So the old projects are at a different rate, but the new projects are coming at a much more lower rate, which is going to impact your cash flows. Your cash flows, which will be available for servicing the debt, will be impacted. And then again, there will be a panic against with the banks and the investors whether the project is bankable at this stage or not. So we need to understand what are the different tools, how we can capture in our PPA agreements, how do we have different merchant agreements as well, which we can define and which we can capture in the agreement so that the revenue can be forecasted. Counterparty, again, very important. There will be multiple counterparties with which the developer would be signing the agreements. They will be signing the agreements will be with the EPC contractor. They will be signing with the O&M contractor. They will be signing with the OEM suppliers. We need to understand what is the credit worthiness of those. What are the credit ratings of those, right? Whether they would be able to meet their obligations and they would be able to pay us or not in terms of, for the example, off-taker, whether off-taker will be able to uh, pay the prices for which you are supplying the power. Now, grid and connection, as I said earlier, it's an elephant in the room, very important. If you are not connected to the grid at the right time, then you are delaying your project. And when you are delaying the project, then you are not able to complete the construction. You are not able to connect. You are not able to generate the revenues from the project. You need to understand that you will not be able to supply the complete output which you are producing to the market. So there will be curtailments, right? So you need to understand what kind of tools which I need to deploy in the agreements to understand whether we have deemed energy clauses within the agreement so that we are able to mitigate those risks. Other theories: policy, regulatory, country, force majeure. There you will find all these three risks across all the different infrastructure, renewable, and utility projects. They are not new, but we need to capture those risks because policies are changing. What if the policy of grid connection change? We have seen recently in most of the market in Europe, they are introducing the financial guarantee. Right now, that is coming as a shock to all the developers because you're talking about 1.5 to 2.5 million of dollars standing just to have the financial guarantees ready before you get even connect to the project. So we need to be aware of the policies which are changing in the market so that we absorb those risks, we are prepared for that. In the same way, country, any kind of forex reserves which change, any kind of war type situation which we have recently seen in the market impacts the cost and impacts the project in overall in terms of its timeline, in terms of its budget. So, and finally, force majeure, again, we have seen in the last 5 years when COVID hit the market that most of the contracts which did not have very strong force majeure, they suffered a lot, right? So you need to understand under political force majeure, under natural force majeure, how these clauses can be structured so that the lenders and investors can look at those clauses and see how they can recoup their investments which they have made in the market by making the project successful, right? So now these 9 risk categories are there, but the question arises, where are these categories should we start with, right? Where do we map these categories, right? And that is why the next slide is very important. So what I have done on this slide is I have tried to map those 9 categories of the risks against the different 5 phases of the project. Now, these 5 phases are planning and feasibility on the left, and as you move towards the right, it's operation and maintenance. And all these risks, they don't basically start and end at the initial when you identify them and when you register them in a risk register. No, they keep on transitioning from phase to phase, right? So you will see here that the red being the color which basically concentrates highest risk. So you will see the phases where you have deep concentration of red. Those are the risks which are high during those phases, and pale blue being something which is barely you should concern about it, right? So let's basically take the example of 3 different phases and see how risks basically transforms from phase to phase. Now, under development and permitting, we see the grid connection and policy and regulatory requirements. It is the deep concentration is of the color is basically red. Why? Because you can get exposed to any changes in the policy of the government in terms of grid connection. So if government comes up with any kind of policy, then your grid connectivity gets affected, your connection gets impacted. In the same way, if there is any change in the policy, for example, we are seeing that in China, soon they will be moving from feed-in tariffs to the competitive auction pricing of the tariffs. That would basically impact the uh, project economics. So we need to be aware of what kind of policies are changing under which phase, right? So because once we move from development to permitting to construction, you will find construction is the phase. You will find the deepest concentration of red under this, because this is one of the core phases which developer or the lender or the investor is looking at, right? Because there can be EPC overruns, there can be delays. So they are working out to see how we can have liquidated damages in the EPC contract, so that if the project does not perform, or if there is any shortfall in the project, then we can reimburse that cost through liquidated damages. In the same way, we have the delay in startup insurance. So if there is any delay in the construction of the project, then we see that how we can basically call that insurance, and our loss in the cash flows would be recouped through those insurance tools. Now, as we move from construction to operation, our risk changes. So, but our risk doesn't basically stop at construction. It evolves, it takes a different form when you move to operation and maintenance. Now, in operation and maintenance, revenue and market becomes more important, and it will be the risk which can be categorized under the category of high, right? Because any movement in the PPA prices is going to impact your project, right? So revenue and market is this. So the risk does not stop at construction, but it evolves in the market. The question of bankability changes at this stage. The lenders basically ask, the question basically changes from whether the project can be built, or it changes when it moves to the operation maintenance. It transitions to whether my project would be able to generate enough cash flows so that I can service the debt, right? So the bankability lens completely changes if you move from construction to the operational phase, right? So this, I would say that this is one of the most important slides in terms of mapping your risks, because once you disintegrate your risks across through different phases of the project, it becomes much more easier for you to highlight those risks, and you can individually understand that what kind of mitigation I can deploy to make that project more bankable, right? So I hope everyone is following up, and if there are any particular questions, then you can place those questions in the chat, and we'll be taking those questions at the end of this session. Right.
Thank you, Saad. I was just about to jump in and
Okay.
and make that announcement. Yes, while you're grabbing a sip of water, it's very interesting what you're sharing, and I'm sure our audience find it very valuable. So yes, please post your questions in the Q&A option for those who don't know how to reach it. If you're using laptop, at the bottom is your navigation panel, and there should be a Q&A, or click on more, and then you will see Q&A button. You post it there. We will address as many questions in the end of the webinar. Just for those who joined later, just quick announcement as well. As you know, and for those who don't know us, we are deal advisory and a co-developer focusing on green energy and sustainability projects. So mostly it's solar, wind, hydropower, geothermal, waste to energy, energy storage, hydrogen production, and data centers. So our primary focus is on Europe nowadays, but of course we also work with North America and and Australia and some politically economically stable emerging markets, including some African countries as well. So we have a network of more than 900 qualified professional investors, mostly funds, starting from family offices and private equity up to large infrastructure, pension, sovereign funds. We work with a lot of strategic investors, pretty much all large IPPs, independent power producers in our network as well. We also work with EPC plus F, we work with development banks, export finance institutions, and many, many other huge funds. So I will be posting a link in the chat now where you can actually submit if you have a project, if you are a developer, or you have access to someone else's project, we can also explore with you a referral program, and and then agree how we can work in this direction. But basically, if you have a project or have access to project, you can click on the link that I will be sharing now in the chat, and then after the webinar, fill out the form. We actually then will be analyzing those projects. We work with large utility scale projects. So anything above 10 million euros we can consider. Of course, most of our projects are above 30 million. So we don't work with very early stage, preferably, in advanced stages or closer to ready to build. But yeah, please post, fill out the form, and then we will review and get back to you. I will make then one more announcement closer to the end before we start Q&A, but Saad, for now, over to you back again.
Yeah, great. Thanks a lot, Vlad. And so I think once we have identified the risk, once we have mapped those risks through different phases of the life cycle, let's basically deep dive into those risks separately. Though I have explained those risks in beginning, and I'll go through these slides because there are 9 risks. I don't want to spend much more time over here, which we have already discussed. But we need to understand that resource risk, right? We understand that the resource estimates for variable renewables are inherently probabilistic, right? The standard way to express them is the p-value framework, which describes the probability that actual generation will exceed a given threshold. So P50, P90, and P99, usually investors look at the P50, it is a little bit more optimistic assumption of the energy which is being generated, and P90 is the probability of exceeding, which lenders basically look at it as a more conservative way. So because they want to have a most conservative approach in terms of understanding whether the debt services, whether debt can be easily serviced or not, right? So that is one resource run. Moving to technology. Now, technology is very important because it fails in a different way. Every technology has a different technical failure profile. Lenders, therefore, do not teach, or they do not basically treat technology risk as one generic risk. They ask how exactly this technology fail and what revenue loss can it create and who absorbs that loss. And that is why we have so many warranties, performance warranties. We have insurance tools which helps to mitigate that risk. Now, the problem which is emerging, that the technology is evolving, right? So the performance warranties which already exist, and as technology changes after 12 to 18 months, it becomes very difficult to have a long-term insurance and long-term warranties. So in that case, we have basically observed that they are coming up, insurance is coming up with the tool which is called efficacy insurance. That is for the long term. So that is, even if the project technology fails in between, they can reach out to someone, to the insurance company basically, so that they can call it off. And I would like to emphasize on this, that the developers should explore this option with their insurance consultants, with their insurance companies with which they are engaged, to discuss about efficacy insurance. This is what banks, lenders, investors are looking at, and makes the project, especially the technology, more bankable, right? Let's move to EPC. We have, of course, I'll not go much deeper into it. It is one of the most understood risk, EPC risk, and this is due to the cost overruns from different commodity prices. We are seeing that the volatility in the market in terms of the commodity is there. That is why, which impacts the cost, which impacts the project in terms of the cost, in terms of the budget, in terms of the time. That is why most of the lenders are coming up with the EPC contracts, which can be easily wrapped up with different mitigating tools. We have liquidity damages, performance bond, retention of the EPC payments, and of course, independent engineer oversight to see that the milestones which are being prepared, they are realistic enough, which can be easily met or not. Let's basically move to revenue risk. Now, revenue risk, it varies more by the structure of the contract rather than technology itself. Right now, you see in this slide from the left to right, left side, we have fully contracted projects, and then the right side, we are moving towards the merchant tail, where the off-takers would like to get into the project, which are exposed to merchant pricing. And that is why the requirements from the lenders, requirements from the investors also change as the project moves from the contracted to fully merchant side of it, right? So you can see that the DSCR requirement for those projects which are contracted is in the range of 1.2 to 1.4, because there is a steady and predictable cash flows which they can easily gauge. Similarly, the gearing is much higher. They are willing to lend more against the cash flows. So they are sizing the debt on the basis of the target DSCR, and they are able to provide the higher gearing this and long-term tenor projects as well, long-term tenor projects as well. And even equity IRR, the requirements of the equity investor is also low, 8 to 11%. As we move to the extreme side, which is fully merchant, right, where there is a volatility in the market, but at the same time, there is an upside which can be easily shared. The requirements are different. The lenders itself tightens those requirements. They want to have the covenants which are on the higher side. So the DSCR covenant, it increases from 1.5 to 1.8. Your gearing is much lower as compared to what it was when it was a contracted project. Similarly, your equity IRR, the targeted IRR by the equity investor is also high. So that is why revenue risk is always there. We need to see how can we mitigate it by getting into the signed long-term contracts, PPAs, or we can also have different kind of merchant contracts, which we will discuss in subsequent slides. But there are different options, best, especially in the battery energy storage system, which is evolving with every year. So we'll discuss that in subsequent slides as well. Now, counterparty risk, again, very important, because in these projects, you are going to sign an agreement with the different parties. You're going to sign an agreement with the EPC contractor. You're going to sign the contract with off-taker, OEM supplier, and OEM provider, right? So any default or any of these projects is going to impact it. This is a bigger risk. So in order to mitigate this risk, you are trying to answer the questions during the due diligence, that who has the credit to back the obligation which they are committing to? What is the rating of these counterparties? Is there any parent guarantee which is available, which can be called off, right? Which can be called out? And similarly, are there any collaterals? Are there any line of credits which are available? So, and what happens if the project defaults? So these are the questions which are being asked during when you are analyzing the counterparties. One of the most important which everyone should do, and that is why we are having the different phases of procurement, right? We are having requests for qualification to see whether the parties are eligible for these projects or not. Moving to risk, which is great. Now, the idea of this risk can be gauged from the fact that there's spent of around $470 billion in the market in 2025 just to upgrade the grid, right? So the kind of demand of energy to connect to the grid is required is huge, right? And this risk is one of the most important risks because it delays your entire project. Any connection delay, right? When you're sitting in a queue for 5 years, it impacts your construction, it impacts your revenue. You need to understand, you need to have the capacity studies to understand whether there is going to be a congestion within the grid, whether there's going to be a curtailment, to understand that how do we mitigate those curtailment also. And then connection terms. how we are contracting these with grid operators, whether they are firm contracts, whether they are non-firm contracts, right? Firm contracts are those you have all the terms which are already been signed for a longer term. Non-firm, you are not committed still because they are still in a offer stage. So that is why whenever we conduct the due diligence on the documents for the grid offer letters which are there, they are not considered as the bankable documents in the market. They are always considered as the planning documents. So some of the developers approach us that our project is ready to be built with the grid offers, but when you go to the investors in the banks, they are not considered as the document which is a binding document, right? So we cannot decide our financial milestone based on that. Moving to, again, risk 7, policy risk, we need to understand and be aware of the policy changes across your market in which you're having your project. Very important to understand risk about the country and politics. It's very, again, important to understand whether how my repatriation of my investment will be understood, whether we are allowed to repatriate our investments or not, how the forex market is moving, how the forex can be easily hedged. So we need to understand that within country and political risk. And finally, climate change, force majeure environment, we need to see how the market is going to be impacted because of the climate change. Recently, last year, we have seen in Canada, because of the fires, the solar irradiance was quite low as it was expected, and because of that, the output in terms of the generation was impacted, and which finally impacted the final cash flow numbers. So that is why these risks are very important to be considered, and to be properly registered, and see how we can basically deploy different tools, different technology, which is aligned to the market, which is very well understood in the market, and which can be easily accepted by the lenders, by the equity investors, to make the project more bankable in nature. Now, this is, we have summed up what we have basically discussed now. I'll not go into detail. We have technology-wise risk. You can easily map it to our phase-wise slide, where we have seen that the different risks were mapped to different slides for different phases of the project. Here we are mapping it to different technology based on that. So I'll quickly move through this. And again, this is again a checklist, what we have discussed till now, that what lenders actually check to see if the project is bankable. Before that, they can make their first drawdown, right? So site control, resource studies, EPC contracts, PPP offtake agreements, O&M offtake agreements with availability and the performance guarantees, grid connection, insurance packages, DSRA, MRA. Those are the financial reserve accounts which are considered while mitigating the financial risks. So these overall, you can refer to this presentation and understand this could be the checklist we should be looking at the project while thinking that we are reaching at the RTB stage. So before that, a checklist which provides a comprehensive view whether the project can be considered as bankable or not. Now moving to the more interesting part. So we have classified the risks. We have mapped those risks basically. And now, what is the mitigation framework, right? What is the mitigation framework which we should apply to mitigate those risks? Now, rather than going into each risk and saying that we have to deploy this mitigating factor, I have divided all those mitigating factors through 4 levers. There will be 4 levers which are used in combination, never in isolation, which can be used as the mitigating tool. We have contractual, we have financial, we have technical, and we have insurance. These are the 4 levers which should be considered to mitigate this. Now let's basically go one by one with all these contractual mitigation framework. So these are the contracts we sign when we get into an agreement. We have a PPA, offtake agreement with the offtaker. We have EPC contract. We have O&M contract. We have supply, OEM, warranty. We have a connection agreement. We have direct agreements which lender has with all the other counterparties, right? Now, these contracts are allocated to these risks, to mitigate these risks. So we have PPA and offtake to mitigate the revenue and market. So we will have long-term fixed index price or tolling for maximum certainty of the cash flows, right? So then we will have EPC contract for mitigating any risk which comes or falls under the category of construction and technology. We will have fixed price, certain date contract. We will have liquidated damages for any kind of delays. We have performance liquidated damages, right? So we need to check whether our EPC contracts have these terms, have these mitigant tools, have these clauses to mitigate that particular risk. Moving to O&M agreement, do we have performance and availability clauses within the agreement, right? Especially then we move to supply, connection, and direct, as we discussed previously. We need to see whether we have signed grid agreement. We need to understand what is the defined firm capacity of the grid, whether there are going to be curtailment. If there is going to be curtailment, it needs to be properly defined that who is going to pay for the curtailment. So usually we have deemed generation clauses in our connection agreement, which clearly says that if the grid is not able to take the output because of congestion, because of curtailment, then this is basically the clause. This is the mechanism through which they will be compensated, through which developer will be compensated, and that is clearly defined under deemed energy clause, right? So these are the tools these are the mitigating tools through which you can mitigate the risk which comes under the contractual mitigation. Secondly, second lever, financial mitigation, very important to understand, because when we are evaluating the financial models which we receive, we see those are very basic financial models. They are not the models which can be considered as bankable by the lenders or by the investors, right? We need to understand proper cash flow waterfall, that how the cash flow is being generated and how we are paying that cash flow to the lenders, to the equity holders, and are we developing some reserve accounts to mitigate the risks in case we don't generate enough cash flow for 6 months? So first is basically reserve account. We usually have debt service reserve account, major maintenance reserve account for 6 months to see if there's any kind of if you basically not able to generate cash flows, then you have a reserve from which you can uh, pay that amount. Similarly, hedging is used for forex reserves. We have sponsors support, or we can also call it sovereign guarantee from the government in itself, which we have seen mostly in African countries. They are coming up with these sovereign guarantees to show the sponsor support, and of course to structure the debt in such a way that it mirrors the tenor of the contract, right? It's very important. So these are the financial mitigation tools. Then technical mitigation tools. We need to have an independent technical advisor, which is appointed by the lender or from the bank side, who reviews the EPC O&M to see whether everything is in, all the contracts are in place, and it's a binding contract. Similarly, we have yield assessment, P90, P95, Tier 1 OEM selection. We are selecting the best OEM supplier and the best technology in the market to reduce the risk which is related to technical side of the project. Insurance and risk transfer. Now, this I understand that this is one of the most important mitigating tool, because you have to see the project in construction phase, you have to see the project in operational phase. Those tools will differ when you are constructing the project and when you are basically in the operational stage, right? So you need to have construction all risk insurance. You should have delay in startup insurance, any insurance which is related to third party liability. And in addition to this, you should basically discuss about the efficacy insurance. I'm emphasizing on that. Now, in operational phase, you should be basically looking at what happens if my business interrupts, what kind of mitigating tool which I should bring in so that my loss is basically mitigated. In a similar way, we have political risk, parametric, weather covers. Those tools are there, which needs to be discussed with the insurance market insurance players, right? So these are 4 different levers which usually are in the market through which you can mitigate the risk. Now let's basically see how do we deploy these mitigants, right? How we can deploy the strategy in which the in which these risks are mitigated, right? Let's take one example of EPC contractor defaulting mid-construction. This is one of the anchor risk, right? And how do we treat it? How do we try to reduce the risk, right? So we need to basically mitigate the risk through 4T's strategy. We need to see how we can transfer the risk, and we need to see how do we treat that risk, how we tolerate the risk, and how do we terminate the risk. And all these risks will go hand in hand. You cannot have only one strategy deployed and you don't focus on treat, tolerate, and terminate, right? So that is why this is very important to understand this strategy of 4T's. You are looking in terms, let's see the transfer, right? When the developer is trying to understand, how do I transfer my construction or EPC risk, right, to the EPC player, contractor. So they will ask for performance bond from the EPC contractor. They will have parent guarantee so that if any default happens, they can call out that parent guarantee. They will have delay in startup insurance, that if there are any revenue losses because of any slippage in the schedule of the work, or there is a cost overrun, then they can call out the delay in startup insurance, right? That is, you have transferred the risk. But before that, and let's understand how do we basically treat it, so that we try to treat the risk at all, right? So before we select the EPC contractor, let's have a pre-qualification round where we try to understand the strength of EPC contractor, because your project can be financially very strong. You can have a very strong project dynamics, project economics, right? But if your EPC player is not financially sound, and if he defaults, then it becomes very difficult for you to get your basically get the reimbursement, right? So you will have EPC pre-qualification to understand that the EPC player is eligible. You will have independent engineers to see all milestones are properly vetted. You have milestone payments to see the milestones which are basically structured, they are mapping with the reality or not. If not, then the independent engineers basically look at and try to restructure it. In the same way, how do we absorb it? How do we tolerate that risk? So usually EPC retention, the 10% of the payment of the EPC will be retained by the developer, right? They will ask for any kind of sponsor support from the EPC player, and they will have the cost overrun reserve. So they can be contingency reserves, they can be management reserves. Contingency reserve will always be part of your project cost, but management reserve will not be a part of your project cost. It will be kept aside by the management to understand and to mitigate the unknown, because you have cost overrun reserve for the contingency which can trigger, and that if that triggers, then I can use my funds in the contingency. But in order to mitigate the unknown, you need to have the management reserve, and which can be called out at the time if there is any event which triggers, which was not known to any parties. And finally, which no developer basically wants and no off-taker wants, terminating the project. While you are terminating the project, you need to see whether the lender basically sees whether I have direct agreement with all the parties, which provides me a cure period, which also provides me the right to step in, so that I can see how can I replace the EPC contractor? How can I come up with material clauses for material adverse changes, which are MAC clauses, right? So all these different strategy of transfer, treat, tolerate, terminate needs to be deployed at the same time and not in isolation, which will mitigate your risks. At least it will make your project robust enough so that you can go out to the lenders, you can go out to the investors to see that you have different layers which are mitigating the risks, right? So I think this was all about the framework of the risk, bankability, and mitigation, where we have defined how to identify the risks, what those risks are, and what are the different mitigating tools through which, or mitigation framework through which you can mitigate the project, and what strategy I need to deploy in terms of mitigating it. So it's transfer, treat, tolerate, and terminate, right? Now there are two. Vlad, you have anything, or shall we?
Well, we have a number of questions, so perhaps instead of kind of addressing, I know you wanted to go over those couple of case studies. Do you prefer to do that, or shall we jump into questions? Whatever works for you. We a little bit over time, but I think people are still hanging with us. So,
We can
yeah,
take questions.
yeah, we have a number of questions. You want to quickly look at the case studies and then into questions, or shall we start with questions?
We can. What's the time? How much time do we have in it?
Well, I mean, we finished an hour, but I mean, people are still
Okay.
here.
Let's take questions then. If you want to take
It's a
questions,
good signal. It means that the content is valuable and relevant. It definitely resonates with what we do here, and that's why we're very happy to have Saad as part of our team. Risk mitigation is of paramount importance, to be
and
honest,
I think
especially.
yeah,
Mhm.
one disclaimer that 1 hour was not enough because that's why I had to rush with
Yes,
those
yes, yes,
because it's such an exhaustive topic to look at because
yes.
when we start working on risk mitigating approach when you're doing the project it's evolving every month, right? It
Of
never
course,
ends.
of course, and especially now when investors are very cautious, and we're seeing this transition, and people are this developers are underestimating how important it is to identify risk and present the mitigation strategy. So I urge all of you guys who are involved in project development to take this seriously, identify the risk, work on the mitigation strategies, be transparent. And if you have projects, as I mentioned earlier, please submit them to us. We work with large utility scale green energy and renewable energy projects. And anything above 10 million euros we can consider, but nothing too early stage. We don't do new technologies that are not commercialized or ventures and startups based on new technologies. So this is for projects like solar and BESS. We focus a lot on PV plus BESS and standalone BESS and data centers as well. I will again repost the link for you guys to be able to share the projects, to the form that you can fill out and share the projects with us, or you can simply reply to the follow-up email that we will be sending tomorrow with the recording and of course with Saad's presentation. And yeah, so we actually offering a complimentary 30-minute introduction and review call with our team. And then once if the project meets our criteria, then we will eventually provide you with feedback on bankability, on investor readiness, on capital structure, and of course with Saad's contribution, feedback on potential risks, and then we agree how we can move forward and get your project funded. So if you have a project, reach out to us. So now let's go into Q&A. We have a number of questions. Let's take next 10 minutes for those who have time to stay with us and address as many as possible. Yes, Saad? So let's start from the beginning. So with clean energy investment reaching 2.2 trillion, what are the biggest factors preventing more projects from becoming truly bankable?
I think one of the key risks which we have clearly observed is the grid connectivity and grid capacity. That is the key, right? Because that is why we always urge our developers who comes to us that let's have the grid study with them so they have understood that the location which they are targeting, what is the capacity, what is the spare capacity of that grid, right? And what is the plan of the grid operator? Are they planning to have sufficient capex or upgrade plan for the next 2 or 3 or 4 5 years so that then they can think of coming up with those projects in those locations, right? So I think right now the one of the most important binding risk is the grid connectivity.
Mhm. Yes, no, I totally agree with you. You mentioned some software. Was it solution? Because there is a question, well, related to identifying risk and managing risk. So is there a software that exists that can
No.
evaluate
So
or
that's
manage
why,
it?
yeah, that's why I said that five lens identification approach, you will not find that approach in any of the textbooks. That is basically based on your experience, right? When you start working on the project, then last 15 years, in my experience, I have realized that how do we basically capture those risks? Because what we used to earlier in my earlier career, what we used to do, we used to have um, benchmarking exercise, right? We used to carry out the benchmarking of similar projects in the similar region and see what are the risks which they have captured. But you are focusing only, as I said earlier, you are focusing only at one aspect of it, right? So you will be able to capture certain risks, but at the same time, you need to understand that risk is shifting, it is transforming across the phase, and that is why you need to cover all the angles of capturing it. And that is why that approach was laid out by me.
Mm-hmm. Makes sense, yes. And in terms of the P50, P90, all this, the factors that you mentioned, why at all consider P50 as this would be misleading on actual performance?
So P50 is usually considered by investors to see the upside of the project, right? That is from the equity as I said, from the equity investors lens. They usually come up with their base case with P50 to see the upside of the equity. But when it's going to the lender side of view, they always basically want to have a very conservative view. We all know that whether it is renewable energy or whether it is any other sector, they want to have the projections at a very conservative level. And that is why we need to make sure that what is the actual difference which P50 yield assessment and P90 yield assessment is generating. What is the difference, right? So that you can understand the downside of it as well.
Mm-hmm. Question from Albert. Can we model different types of lenders during the project life cycle? I mean, lenders who are there only for a part of the cycle and not from A to Z, such lenders would perceive the risk differently, I presume.
Yeah, so of course, when there are different cycles which are involved, different lenders are involved, different phases. For example, that is why we come up with the refinancing case, right? So that after we have construction loan. So for after once you complete the construction, that you go out in the market and refinance the project because you have more stable cash flows now. So the biggest risk which are sitting at the construction phase is over, right? So you will basically you will go and speak out to the bankers. You can also go out to the project bondholders and see that how do they basically rate your project now in terms of risk when you were in construction phase and when you were. So that is why you can deploy the refinancing technique after the construction is complete to see that how it is impacting your project.
Mm-hmm. Perfect. And so another question, we still have few more, we can take a few more minutes if you don't mind, Saad. But in general, what I'm thinking is like we went into a little bit more details in the first half, and then the remaining slides we have to kind of run through. But perhaps if you find sometimes in a few months' time, if you're available to do a part two, we can consider. And I'm sure people are still hanging with people are still here. So I'm
Because
sure, yeah, we could.
I, that was for purpose, right? Because it's very important to understand uh, for the developer that what these risks are, right? And how we map these risks across the phases of the project. Because sometimes that perception is completely different, right? When you when you meet the developer and when you start doing the due diligence exercise, you can easily see the gap.
Mm-hmm,
And
mm-hmm.
that is why I wanted to focus on the first part of
Yeah.
the presentation.
Yeah, no, that's totally good. But I just don't want us to all of this hard work that you put in and all of this I don't want because of the time constraint to be wasted. So I'm thinking maybe at some point we'll have a second part for the risk mitigation because it's quite important topic. But it's a very good question that is straightforward and it's actually addresses the value that we add. So the question is, what are the real RTB parameters that the lenders expect? Why it addresses, why it's actually touch what we do is because we actually help developers to bridge that bankability investor readiness gap. We address, Saad is very much involved in the process where he analyzes the project and then identifies those gaps, and then together we also. So, but I'll let you, Saad, kind of elaborate on this a little bit more, and especially what parameters lenders expect for the really RTB project.
Yeah, so I think the one factor which stands out the most is the financial model, right? Your financial model needs to be bankable. It needs to have all the reserve accounts. It needs to be properly debt sized based on the target DSCR, right? So it is much more easier for for the lender to see the entire cash flow, right? So if he understands that the cash flows available for debt servicing could be uh, could be at risk, then they can implement other mechanism within the model. They can have the what we call the debt service reserve accounts. They have the cash sweep coming in, so that once it can direct. So after even paying, you have a cash sweep of 50%. It can basically get your debt serviced. But in addition to that, as I told you earlier, all those permits, all those studies, especially yield study, yield assessment study from the reputable technical company, it's very important, right? And grid availability, grid capacity, grid connectivity in other than the construction permits for the best storage for the for the wind projects as well as for the solar projects also is very important. So if you have the permits, you have the approvals, you have the right financial model built, considering all the bankable aspects of the project, then we can say that it can be considered as ready to build.
Yeah, I agree. Last question, if you don't mind. So we'll basically, it's quite a general question, but in typical from your experience, how long it takes to get to financial close?
Yeah, it's a very tricky question because it because it again it, it depends on the planning. But if I go to a very conservative approach, pessimistic approach, it will take 9 to 12 months, right? If you are going with a very optimistic approach, it will take minimum 6 months.
Correct. That's what we are also seeing, to be honest. Perhaps the little remark is needed here. To reach the financial close, if the project is 100% ready to build and all
Yeah.
the risk identified, and depends where how complex the project, how big it is, which country, which technology. In ideal world, project can be closed between 4 to 6 months, because full commercial grade due diligence from investors takes between 8 to 12 weeks. That's your
Yeah.
2 3 months minimum, and then so 4 to 6 months from 100% ready to build to financial close is possible. Again, in our experience over the years, we're seeing that there are certain milestones are not accomplished by the developer. There is a gap between developers understanding what is ready to build and investors' perception of what is ready to build. There are delays providing information. There are sometimes delays from investors making their decisions. So, a simple project can take up to 12 months to reach financial close. And again, if it's not ready to build, then it takes some work to reach to that stage. So thank you very much, Saad. Really appreciate your all the wisdom that you shared with us. A lot of good questions. We have missed few, but I think in general we have covered most of the important questions. And we all the notes, not the notes, the presentation and the link to submit projects, if you have access to projects or you're developing yourself. And of course, the recording will be shared with our audience tomorrow, so you will get everything. So thank you everyone for being with us today. Thank you, Saad.
Thanks,
Have a
everyone.
great day. Take care.
Thank you. Thanks a lot. Bye
Bye.
bye.